You thought you did everything right. For 3 decades or more, you followed the rules. You maxed your 401k, you funded your Roth, you paid into Social Security with every paycheck. And this is the finish line. But the moment that you start to pull out even a single dollar in retirement, that's when the real danger begins. Which account do you tap first? Pre-tax, tax-free, or government benefit? Thousands of retirees get this decision wrong, and they end up making a mistake in that first year that costs them not just thousands, but $100,000, $200,000 or more over the next 20 to 30 years of their retirement. Because the order you choose isn't just about this year's tax bill. It's a domino effect that determines how much of your Social Security is taxed, whether you get hit with crippling Medicare surcharges, and exactly how much you end up leaving behind for those whom you love. I'm John Norberg, Certified Financial Planner and founder of Norberg Wealth Management. And in today's Financial Prop video, I'm going to walk you through the exact decision tree that I use with my clients to help determine the optimal withdrawal sequence. And I'll show you why what might have worked in 2020 could cost you a fortune in 2026. And if you stick around until the end, I'll also show you how a pension can factor into this equation as well. So that by the end of this video, you'll know exactly which account to pull from first, how to avoid the most expensive mistakes, and the one scenario where pulling from your Roth early actually makes a lot of sense, even though it might feel completely backwards based on conventional wisdom. So with that introduction, I welcome you to this latest edition of the Financial Prop series. Okay, so first let's establish what we're working with. Most retirees have three sources of retirement income. Pre-tax accounts, that is your traditional 401ks, traditional IRAs, 403bs, etc. Every dollar you pull out is going to be taxed as ordinary income. Then you have Roth accounts, Roth IRAs and 401ks. These come out completely tax-free after age 59 and a half, assuming you've held the account for at least 5 years. And then Social Security. Now this is where it gets tricky. Depending on your other income, anywhere from 0 to 85% of your Social Security can be taxable. Okay, so first let's establish what we're working with. Most retirees have three sources of retirement income. Pre-tax accounts, that is your traditional 401ks, traditional IRAs, 403bs, etc. Every dollar you pull out is going to be taxed as ordinary income. Then you have Roth accounts, Roth IRAs and 401ks. These come out completely tax-free after age 59 and a half, assuming you've held the account for at least 5 years. And then Social Security. Now this is where it gets tricky. Depending on your other income, anywhere from 0 to 85% of your Social Security. Now here's why the order matters. When you pull money out from your pre-tax 401k, it increases your adjusted gross income, or AGI. And that higher AGI can push you into a higher tax bracket, which triggers Medicare IRMAA surcharges, which can add $3,000 plus per year to your premiums, and cause more of your Social Security to become taxable. Again, up to 85% of Social Security benefits can be included in taxable income for recipients whose provisional income exceeds statutory thresholds. So for single filers, the first threshold is $25,000, and the second is $34,000. For married couples filing jointly, it's $32,000 and $44,000. That means pulling $50,000 from your 401k doesn't just create $50,000 of taxable income, it can cause an extra $10,000 to $20,000 of your Social Security to become taxable too. And this is what tax and financial planners call the tax torpedo. And it's devastating if you're not prepared for it. But Roth withdrawals? They don't count towards your AGI. They don't affect your Social Security taxation. And they don't trigger IRMAA. From a taxability perspective, it's almost like they're invisible to the IRS. And that's why the withdrawal order you choose can easily be worth $100,000 to $200,000 over a 25-year retirement. Right, so let's talk a little bit about the conventional wisdom first, right? For decades, the standard advice has been withdraw from your taxable accounts first and then tax deferred and Roth last. And the logic for that was simple. Let your Roth grow as long as reasonably possible while you drain down your pre-tax accounts. That strategy was built for a different world, a world where RMDs started at age 70 and a half, where tax rates were higher, where Medicare IRMAA wasn't as punishing, where Social Security taxation thresholds were different. Now here in 2026, the landscape has completely changed, and it's a much different world. RMDs, or required minimum distributions, of course, now begin at age 73 for individuals who were born in 1951 or later, which gives you more time before forced withdrawals kick in. And that age is also scheduled to increase to age 75 in 2033. Now, in addition, Roth 401k plans are no longer subject to RMDs during the account holder's lifetime. This is a major shift from the old rules. But here's the problem. If you follow the old playbook and drain your 401k first, you're stacking massive taxable income in your 60s and early 70s. Then, when RMDs hit at age 73, you're forced to take even larger distributions on top of Social Security that's already 85% taxable. And you're going to end up in what I call the tax compression trap, where all of your retirement income hits in a narrow window at the highest possible tax rates at the time. The better strategy? Strategic diversification of distributions. You blend withdrawals from different buckets to manage your taxable income year by year, keeping yourself in the lowest possible bracket while maximizing tax-free growth. So let me show you how this works with a few real examples. So let's talk about the first case study. Let's say you're 65, you've just retired, and you're not taking Social Security yet. You're planning to delay until age 70 to truly maximize that benefit. Of course, after age 70, it doesn't matter because it doesn't increase other than the COLA. You have $800K in a traditional 401K, $200K in a Roth IRA, and Social Security projected at $3,500 a month at age 70. And you need, let's say, $80,000 to live on. The wrong move? Pulling all $80,000 from your 401K each year. Might seem simple, but it is in fact wrong. Why? Because if you're in the 22% federal bracket, paying $17,600 in federal taxes alone, plus state taxes, and you're still going to face a massive tax bomb waiting for you when RMDs kick in at age 73. And here in Maryland, our state tax brackets aren't exactly low, so it's going to be even more painful depending on your state tax. So what's the right move? A blended strategy. We would pull, say, $50,000 from the 401k and $30,000 from the Roth. Now you're only paying tax on $50,000, which keeps you in the 12% bracket, about $6,000 in federal taxes instead of $17,600. That's $11,600 saved every single year. Over 5 years, age 65 to 70, that's $58,000 you didn't send to the IRS. But here's where it gets even better. During those 5 years, let's say you're also doing strategic Roth conversions. Now, since you're only pulling $50,000 from your 401k, you have room to convert an additional $40,000 per year to Roth while staying in the 12 or 22% bracket. Over 5 years, you could convert, let's just say, $200,000 from pre-tax to Roth at low tax rates. And then when RMDs hit at age 73, your balance is $400,000 instead of $800,000, cutting your required distributions almost in half. Now that reduced RMD means less taxable income, less Social Security taxation, and no Medicare IRMAA surcharges. The result? You've saved about $150,000 or so in potential lifetime taxes just by changing the withdrawal order and adding strategic conversions during your early retirement years. All right, so let's talk a little bit more about the traditional retiree, right? Let's say you're already 73 and facing required minimum distributions. And let's say you have $1.2 million in a traditional IRA, $300,000 in a Roth IRA, a Social Security of $2,800 a month, that is $33,600 per year. Your RMD at age 73 is calculated by dividing your December 31st account balance by your IRS life expectancy factor. And at 73, that factor is about 26.5, so in this case, your RMD is about $45,000. Add in Social Security, and you've got $78,600 in income before you even choose to withdraw anything extra. But now you need another $35,000 to cover your living expenses. The wrong move? Pulling that $35,000 from your traditional IRA on top of your RMD. Now you have $113,600 in total income. At that income level, up to 85% of your Social Security becomes taxable, adding about $28,000 to your taxable income. Your total taxable income, therefore, is now roughly $108,000, composed of your RMD plus your IRA withdrawal plus 85% of your Social Security. You're well into the 22% bracket, and you're triggering Medicare IRMAA surcharges. A better move? Pulling that $35,000 from the Roth instead. Now your taxable income is at just $73,000, the RMD plus Social Security at 85%. You stay in the 12% bracket, avoid IRMAA, and save about $4,000 per year in taxes. Over 15 years, that's $60,000 in tax savings, just from choosing the right bucket. And here's the bonus. Because your Roth isn't subject to RMDs anymore, thanks to the Secure 2.0 Act, that $300,000 can keep growing tax-free for the rest of your life, or get passed to your heirs as a tax-free inheritance. Not half bad. So now let's look at a more complex scenario. A married couple, both 68, with substantial assets. They've worked hard and they've saved hard. They've got $2.5 million in traditional 401ks, $500,000 in Roth IRAs, and combined Social Security of $75,000 a year. They also have a pension of $30,000 a year. Now they need $150,000 per year to maintain their lifestyle. Here's the math. They're already getting $105,000 from Social Security and the pension. They're going to need another $45,000. The wrong move, you might have guessed it, would be pulling $45,000 from the 401k. For married couples filing jointly, if provisional income exceeds $44,000, up to 85% of Social Security benefits get taxed. And at their income level, they're already maxing out Social Security taxation. Adding $45,000 from the 401k pushes their total taxable income to around $158K. They're solidly in the 24% bracket, and they're paying massive IRMAA surcharges on Medicare, coming close to $6,000 extra per year combined. So the right move would be pulling $20K from the Roth and $25K from the Roth and $20K from the traditional. That drops their AGI to $133K. Now they're still in the 22% bracket, but they've eliminated IRMAA surcharges by staying under the threshold. So that's $6,000 per year saved through Medicare premiums alone, plus about $2,500 per year in reduced income taxes. Over 20 years, that's about $170,000 in savings. But here's the strategic layer. In years where their expenses are lower, maybe they're traveling or they've paid off the mortgage, they can do additional Roth conversions to bring that 401k balance down before RMDs hit. They're playing the long game, managing their tax brackets year by year and potentially saving $300,000 or more over their lifetime through strategically working with their financial advisor to make this happen every single year. Now let's talk about the scenario that confuses people. When should you actually pull from your Roth early? Even though conventional wisdom says that you should save it for last, there are a few situations where tapping your Roth makes strategic sense. Number one, you're already in a low tax bracket and you want to stay there. So if you're pulling just enough from your 401k to fill up the 12% bracket and you need more income, pull from Roth. Don't bump yourself up into the 22% bracket just because Roth should be saved for later. Number two, you're approaching Medicare enrollment and you want to avoid IRMAA. In the 2 years before you turn 65, your income determines your Medicare premiums. So if taking an extra $10,000 from your 401k would push you over one of those thresholds, then pull from your Roth instead. Number three, you want to preserve your Roth as a tax-free inheritance. Roth 401k and Roth IRA accounts are no longer subject to RMDs during the account owner's lifetime, but the beneficiaries may still face distribution requirements. If your goal is to pass Roth assets to heirs, use your pre-tax accounts for living expenses, and then just preserve the Roth for your legacy. The key insight here is that Roth isn't always last. Think about it like a lever you can pull to help control your tax bracket, particularly in years where more income is needed and maybe you're close to that next bracket. All right, so let's talk about your 2026 withdrawal checklist, bringing all of this together with some practical next steps that you can use right now as we head into 2026. Step one, create your baseline income. So sit down, pencil and paper or calculator, however you prefer, and add up your Social Security, pensions, rental income, and any other guaranteed resources. This is what we'll call your floor. Then step two, determine your total income need. What do you actually need to live on? And be realistic. This is your target. Might help to go through the last few months of credit card bills. Now, step 3, calculate the gap. Your target minus your baseline equals the amount you need to withdraw from your retirement accounts. Which brings us to step 4, run the tax scenarios. Model pulling that gap amount from all pre-tax, all Roth, a 50-50 blend, a 70-30 blend, etc. And see which keeps you in the lowest tax bracket, avoids triggering the 85% Social Security taxation, and avoids IRMAA. And then step 5, looking ahead, consider future RMDs. If you're not 73 yet, project what your RMD will be when it kicks in. If it's going to be massive, you might want to start doing Roth conversions or considering qualified charitable distributions or other strategies. Step 6, reassess annually. Your income, your situation, they change every year. Maybe you have a high expense year, medical bills, a new roof, and so you pull more from Roth. But maybe it's a low expense year and you can convert more to Roth instead. The key is it's dynamic, and having a plan is going to make it all work. So here's the bottom line. The order you withdraw from your accounts in 2026 and beyond can be worth 6 figures over your retirement. The old playbook, to drain pre-tax first, save Roth for last, just doesn't work anymore. Not with RMDs starting at 73, not with Roth 401ks exempt from RMDs, and not with Social Security taxation and Medicare IRMAA creating brutal penalty zones. The winning strategy is dynamic, strategic, and tailored to your specific situation. You blend withdrawals from different buckets, you manage your taxable income year by year, you do Roth conversions in low tax years, and always run the numbers before making a move. And yes, this is a bit of a selfish plug, but it's worth it to work with a professional on this. If you want to see exactly how this applies to your situation, your specific numbers, income, etc., I'm offering a free personalized retirement plan video that walks through your numbers and shows you where you might want to make changes. No meeting, no contracts to sign, it's 100% free. And all you have to do is click the link below in the description to get your personalized video. Because retirement isn't about how much you've saved, it's about how much you get to keep and what you do with it. So with that, I'm John Norberg. Thanks for watching, and I'll see you out there.